Hey everybody, how you guys doing? Welcome to week 2. This week I have a couple of videos for you. One is going to be on transaction analysis, which is in your chapter 4 of your textbook. We'll do the transaction analysis, we'll revisit income statement, statement of owner's equity, we'll actually retained earnings statement, and then we'll also look at a balance sheet. And then in the second video, we're going to be doing a cash flow statement. All right, so stay tuned for the other one. So let's get started. I'm going to get my audio my video off. So now you got my picture, and we are going to be looking at the transaction analysis. Hopefully you can see it. If you happen to have your textbook handy, you will find this information starting on page 143. Looks like I have a typo here. And this information spans from page 143 all the way to page 147. So I thought I would go through the example that's in the book because I don't think they do a good job of really explaining it as well as I would hope. So I thought maybe we can kind of go through it. And what I would recommend that you do is maybe stop this video right now and go into Blackboard and maybe download a copy of this sheet that I'm working with. This way you can kind of follow along. Okay? So pause right now, go print that sheet, and then come on back. Okay, so hopefully you're back, and I'm at the bottom of page 143. And the first question says investment by owners. Now, if for some reason you don't have your textbook, if you scroll all the way down, you'll see I have summarized all the transactions here. Okay, a little bit of more of a succinct style than what they show in the textbook. They've got like paragraphs. I've got just quick little one sentence things that also describes what's going on there. Okay. So in case you don't have it, you know, when you go to, if you've printed the sheet, you already see these transactions. Okay, so the first transaction is the investment by owners. And if you read that, you basically come to the conclusion that the stockholders have invested $1,000 cash in the business in exchange for common stock. So what's going to happen here is the company's cash is going to go up by $1 million. And at the same time, whenever, oh, by the way, if this ever happens to you, if you're ever working in Excel and you see these little hashtags or dollar signs, it just means your row is not wide enough. So just stretch it a little bit until those numbers appear, okay? And the same thing with the common stock. So whenever the owners purchase, basically become owners of the company, they buy into the company by giving the company money. The company now has that cash, and now these stockholders actually have stock that represent their ownership. So once you've done that, I recommend that we update the balances in each of these accounts. So right now, these accounts that weren't utilized will be 0. All the other ones will be obviously whatever we did to those accounts. So let me just get rid of these, even though it's made my life a lot easier, but I'm just going to get rid of them because we're going to pretend we don't have that info. And by the way, I already have this document kind of set up so it does the math for me. And because I have it in accounting mode, every time I enter a 0, it automatically converts it to a dash. So if yours is not in accounting mode, don't worry about it. I'm not expecting you to know Excel, but in case you're wondering why some things are happening a certain way, that's why. And notice that my little calculator that I've created over here to the side is going to help me keep track if I'm in balance. Now this calculator won't be available to you on the test, but at the same time, I like to use it instead of using a handheld calculator. I've created some formulas that helps me to do it. And in case you're wondering how I did it, if you ever take your mouse and click on one of those fields, you can see what's happening here. So I took whatever is in B7, whatever is in D7, F7, and H7 in these cells, added them together, and that gave me $1,000, and we didn't need a calculator to tell us. 1,000 plus 0 plus 0 plus 0. On this side, if I click on this 1,000, or excuse me, 1 million, you'll see accounts payable J7 plus whatever's in common stock plus whatever's in retained earnings. Subtract out the dividends, add the revenue, and minus the expenses. So really the only thing so the whole left side is getting added, but when we get on the right side, everything is getting added except dividends and expenses. They're getting subtracted on this yellow row. Okay? So just to give you some feedback there. So the next question that we have, I'm just going to bypass the textbook and just use my little summaries at the bottom, probably a lot easier. It says purchase diagnostic equipment for $200,000. So when you buy diagnostic equipment, I always kind of take the impression that we're supposed to assume cash unless otherwise noted. But if I look in the textbook here just to double check to see if that's what happened, it looks like they actually said purchased equipment for cash. So if you just see purchased equipment, you always assume cash unless they told you bought it on credit. So we're going to buy this diagnostic equipment on the 2nd. So I'm going to go look up here, and here's a column under my assets called equipment, and the amount there was $200,000. So let me put that in there. And because we paid cash for it, my cash is going to go down. When I have my sheet in accounting mode, my negatives turn out to be in parentheses, which I kind of like. And I like to make mine in red, but you don't have to worry about that. But notice that every time I have done a transaction, and this is now the 2nd time, September 1st and September 2nd, there's always a minimum of 2 moves. You always got to do at least 2 things. So those of you with an accounting background, you know that those 2 moves are really debit and credit. But this is a pre-debit and credit approach. Probably the very first accounting class you ever took, you probably learned the accounting this way before you jumped in the debits and the credits. This style is kind of like the balance sheet style. It's not super common, but there are some factions out there that like to use this style, but it's not common in the grand scheme of things. But this is how they use it in your textbook, so that's the way I want to show you. And it allows us to do the accounting without worrying about debits and credits. But let's figure out what our balances are. So in cash, our balance is now $800,000. And these other accounts, there is no change. So my minimum of 2 moves are happening on the white rows, and on the yellow row, I'm updating my balances. And you can see we are still in balance. Now, some people feel a little awkward when they did the one we just did, because it's like, oh, I thought you had to do something on the left side and on the right side. Nope. All you got to do is make sure you have a minimum of 2 moves, and those 2 moves could actually be on the same side as they were in this transaction. Okay, so and we need to be in balance. If you don't do 2 moves, you can't balance, like I said before. Sometimes you do 3 moves, sometimes you do more than 3, but you got to have always at least 2. If you just do 1 move, you cannot balance. Okay, next transaction, purchased medical supplies for $20,000 on credit. So we have an account called medical supplies. So we put $20,000 in there, and because we bought it on credit, we basically charged it. And now our accounts payable will go up by $20,000. This time, the 2 moves, 1 move was on the left, 1 move was on the right. Updating all our balances. hoping that you are in balance after every transaction. And as you can see over here, we are. Okay, so in that first transaction, these were the two moves. In the second transaction, these were the two moves. And now in the third transaction, these are the two moves. So notice the moves are happening in correlation with the dates. Okay? Let's take a look at the next transaction. This one, I just kind of made up these dates. So these dates that I have here on the side don't really match up. So I'm just going to fix them here real quick. So I'll pretend they're like dates, but basically I'm just going in order. Okay, so let's take a look at the fourth transaction. Fourth one says, provided medical services for $50,000 in billings to third-party payers. So we provided a service. So hopefully when you see this, hopefully your accounting classes are kicking in, and when you see something like this, whenever you provide a service, that's revenue. So whatever you do for a living, that's when you record revenue. So if you paint houses, every time you paint a house, revenue. You know, every time you see a patient, revenue. So this is saying provided medical services for $50,000 in billings to third-party payers. So if you're billing someone, that means you don't have the money right now. So that means we're going to have to use accounts receivable. So we didn't get cash for this $50,000. We billed it out. So you're going to put that $50,000 in accounts receivable, and the other move is going to be in revenue. And this is the reason why I wanted to do this example with you, is because your textbook took a massive shortcut. And instead of using revenue, your book put it automatically in retained earnings. We're not going to use retained earnings at all in this discussion. But if you remember in your accounting classes, revenue got closed into income summary, expenses get closed into income summary, and then we close income summary into retained earnings. So basically they're just cutting a corner, all right? They're automatically putting the revenue directly into retained earnings in your textbook. But I'm doing it the real way, the correct way, all right? I'm not cutting corners. So when you provide a service, your revenue goes up. You would have loved to have gotten cash, but we didn't get cash. Instead, we billed it out. So whenever you bill, you are going to use accounts receivable. So updating our balances, we still have $800,000 in cash. We now have $50,000 in accounts receivable. We've got $20,000 worth of medical supplies. We've got $200,000 worth of equipment. I've used this form before, so it's kind of remembering the last time I was in here. That's why those numbers are just popping up or populating on their own. Accounts payable, $20,000. Still have $1 million worth of common stock, and we've got nothing in retained earnings, nothing in dividends. My revenue is $50,000, and my expenses are $0. And as you can see, I'm in balance. So right now, if I were to ask you, does this company have a net income or a net loss? What would you say? If you said net income, you are right. Now, what if I said, okay, it is a net income. How much is the net income? Your eyes should be here only. This is all you have to look at when asked about profitability. So right now the company has $50,000 in revenue, no expenses, 50 minus 0. At this moment, they have $50,000 worth of net income. Okay? This stuff has nothing to do with net income. It's important, but not for the question that I just asked. Okay? All right, let's do the next transaction, which is the fifth. On the fifth, it says incurred advertising costs from the daily news on account. So when something like that happens, you're going to go into expenses, because that's what an advertising cost is. So it's an expense. And I think I left out the amount here. And I think that's supposed to be, hang on, I got to go to the textbook here. This is the fifth one. Yeah, it is for $10,000. So I'm going to put that in here. Incurred advertising costs, $10,000 from the daily news on account. Okay, so we're going to put $10,000 in expenses. And we're going to go to accounts payable and put the other $10,000 in. So we incurred expenses, but we didn't pay for them yet. So we owe this money. So notice the two moves are on the right-hand side this time. So if you're thinking, how is it going to balance if both of these are positives? Well, remember, when we're in this yellow row, we're subtracting whatever's in expenses and whatever's in dividends from this side. So 10,000 is making this side go up, the one that's in accounts payable, but this 10,000 that's under expenses is going to make this side go down. So basically it's a wash. Okay? Your textbook took 10,000 away from retained earnings, because expenses ultimately make your retained earnings go down. So let's update the balances. Still have $800,000 in cash, $50,000 in accounts receivable, $20,000 in medical supplies, and I got $200,000 worth of equipment. My debts have gone up. So I had $20,000 worth of debt, and now I have $30,000 worth of debt. Still have $1 million worth of common stock, and still no retained earnings, there's no dividends. My revenue is $50,000 and my expenses are $10,000. So now if I asked you, does this company have a net income or a net loss at this moment? You would say net income. How much? $40,000. 50 minus 10. That's so they have $40,000 worth of net income. Over here under expense titles, I'll just write advertising, to identify that 10, right? Okay, let's go on to the sixth transaction. In the sixth one, it says paid the following expenses: rent, salaries, and utilities, $50,000. All right, so if we paid, our cash is going to go down by $50,000, and our expenses are going to go up by $50,000. And this is made up of, as they say here, a variety of different expenses. So they've got rent, salaries, and utilities. So rent, salaries, and utilities. Now normally we wouldn't just do this. We would have this $50,000 broken down by how much of it is rent, how much of it is salaries, how much of it is utilities, but for some reason your book is a little lame when it comes to this kind of stuff, so it's not doing it as properly as it should. Again, the reason why I'm doing this with you. Okay, so our balance now in cash is $750,000. These other assets did not change at all. Let me get rid of these. Our debt still remains at 30 grand. Still have $1 million worth of common stock. Retained earnings 0, dividend 0. Still have $50,000 worth of revenue, but I now have $60,000 worth of expenses. So right now the company is operating at a net loss. 50 minus 60 would have $10,000 as a net loss. Okay, so far this company is not doing so hot. All right, the 7th transaction. This one is actually more of what we call an adjusting entry. So again, if you've taken some accounting courses, which I'm assuming you have, or else you wouldn't be in this class, this is considered an adjustment. It says supplies used $2,000. Okay, so that means that some of our supplies that we had, which we had 20,000, they're saying we used 2,000 of it. When we first bought these supplies, by the way, we treated them as an asset. Now we're going to write them off. And when you write off an asset, basically you are going to expense it. Okay, so I'm just going to do this here real quick because this is driving me a little crazy. So right here with rent, I'm going to write salaries and utilities. I hate to take up multiple lines for that. Okay, that seems better to me. Okay, so now $2,000 of supplies were used, so I'm going to get rid of $2,000 worth of supplies. And by doing that, I get to expense them. So my expenses are actually going to go up. And I'll call that supplies expense. Okay. So $750 in cash. We got $50,000 in accounts receivable. $2,000 being taken out of our supplies, so we got $18,000 left. $200,000 worth of equipment. Got 30 grand. We got $1 million still. No retained earnings yet. Dividends are still 0. Revenue 50,000, and now our expenses are up to 62. So now this company is in the red by 12,000, right? 50 minus 62 gives you 12. All right, let's look at the 8th transaction. The 8th transaction says, hey, we paid $10,000 on account. So remember we owed 30? We're going to make a payment of 10. So your cash is going to go down, because how else are you going to pay for it? And your credit card debt or your liability is going to go down by that same $10,000. And again, those hashtags just mean that the field is just not wide enough. So when I subtract 10,000 from 750, I get 740. These other accounts, these other assets remain the same. By the way, I have another video that's very similar to this that doesn't go based on your textbook, but I have another one just like this in my YouTube video, and I'll supply you with that link. And this way you'll have two that are along the same lines here. Okay. Another example, in other words. So we're still in the deficit, 12,000. Take a look at my calculator. Notice that I've been in balance all along. The 9th transaction says paid $20,000 on account. Okay, so another payment on account. So my cash again going down by 20, and I now have no debt. So that's exciting. At least it would be if this was your business. That's one bright sign. So my cash is down to 720 grand. These other assets have not changed, haven't changed in a while. And take a look at your debt. Your debt is now 0. closing these other accounts. So again, I'm still operating at a $12,000 loss. And notice my calculator, I'm still in balance. The last transaction that they have is we collected money. And look what it says here. $5,000 cash received from that third party. All right, so our cash is going up by $5,000. And our accounts receivable is going down by $5,000. So here are the final balances. Our cash ended up at $725. What did we start off with? We started out at $1 million. So our cash really took a major hit. But this is our first month of operations. You can't expect to be profitable after the first month, and as it shows, we are not. Okay, so those are the 10 transactions that they illustrated in the textbook. Like I said, I have another video that I have on YouTube that does another one of these transaction analysis for corporations, and you might want to check that out just to kind of get another example. Okay, so let's go ahead and now do the financial statements that is associated with what we just did. So I'm going to slide over here and do the income statement. So I don't know what the company name is for this business, so I will just call it company name. And then let's pretend it was for the month ended September 30th, 2020. So when you do an income statement, we're going to start off with the heading revenue. That little colon symbol that you see after the word revenue, that means get ready to indent a list of your revenue accounts. Well, if I look at my little chart, I only had one revenue account, and it was called service revenue. So, maybe imagine this was a beauty salon. I could have like 5 different revenue accounts. I could have one for haircuts, for nails. I could have one for pedicures. I could have one for tanning and, waxing and all that other stuff. So for every different type of revenue, you would literally keep track of it as a separate column. Service revenue, very generic. Could mean multiple things. So our service revenue ended up being $50,000, if you recall. And let me put this in accounting mode. If you want to know how I put stuff in accounting mode, I kind of highlight the columns that I want and I go click on the comma. And it automatically puts commas in there. And I'm going to decrease the decimal so that I don't see the cents. So 1, 2. So now my numbers won't have any cents in there. And then my expenses. If you remember, we had advertising expense. And that was $10,000. And then we had this crazy combo thing, which is totally unrealistic. Rents, salaries, and utilities expense. Again, you would never see something like that in real life. They would have been separated out. And then we had supplies expense. And that was $2,000. We would need a math line. I like to use borders when I do my math line. I like a thick bottom border. So now it shows like I got a math line in there. Getting my total expenses. I'm going to add the 10, the 50, and the 2. There's that 62,000 that we saw in the chart. I need a math line. And now 50,000 subtract 62. There's that $12,000 net loss that we've been seeing all along. And we're going to actually call it net loss. All right, so let's clean this up a little bit. We need double underlines under our final answer. That's really important in accounting. And the first number in each column is going to get a dollar sign. And final answer is going to get a dollar sign. So this company's first month of operation turned out to be a little ugly. Okay, they only brought in $50,000 in revenue, but they had $62,000 in expenses. So that created a $12,000 deficit. Okay. Now, if you look at your textbook on page 147, you will see that $12,000 deficit under retained earnings. All right. And yet I didn't use retained earnings at all, but we're about to. Okay. So we'll actually end up with that $12,000 answer that you see in the book. We'll see it in this statement. So name of the company, company name, retained earnings for the month ended September 30th, 2020. And now we're going to start off with our beginning retained earnings. So at the beginning of the month, so 9/1/20. So the beginning amount was 0. Then you would either add net income or subtract net loss. We had a net loss of 12 grand. So 0 less the 12 grand, that's going to give us a negative of 12 grand. And then we're going to subtract out dividends. And we didn't have any. And that'll give us our ending retained earnings on 9/30. So let me clean this up a little bit with my math lines. So 0 plus that negative 12,000 is going to give you a negative 12,000. We're then going to subtract out our dividends, and we didn't have any. And we ended up with a negative 12,000. So now our numbers match up with what's in the textbook. I don't know if it'll let me do a dollar sign. It did. Okay. So we didn't have any retained earnings to begin with. Now, next month when we go to do October's retained earnings statement, this 12,000 that you see here is what's going to start next retained earnings statement. So we'll start with a deficit of 12, and hopefully we will have improved. This final answer, whatever you end up with as your final answer in retained earnings, that's what's going to get copied into the balance sheet. So speaking of the balance sheet, let's do it. So company name, balance sheet, and then the date, September 30th, 2020. And now what we're going to do in the balance sheet is we're going to see, do our assets equal our liabilities plus our stockholders' equity? That's the goal. So let's see if it does. So we're going to start off with assets, the heading, followed by a colon symbol. Remember, the colon symbol says be prepared to indent a list. And remember, we had cash. We're going to take all these: cash, accounts receivable, medical supplies, and equipment. Okay? And then whatever their final answers were. So that's what I'm going to be putting in my balance sheet. So I got cash, accounts receivable, got our supplies, and we have our equipment. In terms of location, where would I put this stuff? Column 1 is designed for like itemizing, and then we use column 2 for the grand totals. So in column 1, I'm going to put the cash amount, and the cash amount was $725. So literally 725, 45, 18, and 200 is what I'm going to put over here. Okay, so 725, 45, and 200,000. Again, your textbook did a side-by-side version of a balance sheet. That's kind of like, you know, grammar schoolish version of the balance sheet. Balance sheets are, 99% you will see them as a vertical presentation. So very simplified way of doing stuff in this chapter. So we're going to write total assets, add these guys together. I get $988,000. So let's do our little, oops, that's not what I want. That's what I want. I don't want that though. Hold on a second. There we go. So total assets 988. Let me do the $ thing. So now we're hoping that the other side of the balance sheet also equals 988. So we're going to start off by putting our liabilities in there. And the liability that we had was accounts payable. We didn't have any. So we'll just put a 0 in there. And now to do the stockholders' equity, our last section. This is made up of 2 major categories, common stock and retained earnings. The common stock was $1 million, if you remember from here. All right, so it's $1 million. The retained earnings, we want to take the answer from the retained earnings statement. So that was a negative $12,000. So $1 million minus the 12, that's going to give us 988. And I'm going to add that 988 to the 0. And that gives me, actually, I could put that 988 on its own line and call it total stockholders' equity, but just to save some time, I won't do that. And double underline this final answer, and now I'm going to call this 988 total liabilities and stockholders' equity. And that's your balance sheet. Okay. So like I said, I have another video in YouTube that's called, financial statements from a corporation point of view. So if you want to check it out, go for it. I also have a video on YouTube where I have transactions from a corporate point of view, where you can see some more transactions. It may not be a bad idea to do that. All right, so that is the first video. There'll be another one coming on cash flow statements. All right, take it easy. Bye-bye.